Good afternoon from beautiful downtown Fremont. I'm Ron Cohen, a tax partner with Greenstein, Rogoff, Olson & Company. This is our weekly tax update. This week was a pretty slow week in the tax world, so I'm going to cover a couple of issues, some from the past and some where history is repeating itself. One thing to look at with regard to partnerships, with regard to husbands and wives. It's often an issue of complication. Generally, husband and wife is treated as a partnership, even though they're married. Technically, they're supposed to file a Form 1065. On that partnership return, report all income and expenses, create Schedule K-1s that flow through to the individual tax return of the husband and wife who file together. So often it seems like a great waste of time, but that's sort of where the law leads you to. Rather, you can make an election under Section 761F, and we have an article on our website that takes you through that, where instead of filing a partnership return, and by the way, the IRS estimates that it can take up to 200 hours to prepare a partnership return correctly, including all the background bookkeeping, but you can make an election where the husband and wife both file Schedule C in the Form 1040. This greatly eases the situation. The Social Security number of both the husband and wife get on the forms, and therefore Social Security benefits are accrued by both the husband and wife on those separate Schedule Cs. Often what people do wrong is they have the entire venture reported as one Schedule C in the joint tax return. One of the taxpayer's Social Security number is put on the Schedule C. That taxpayer receives Social Security benefits for the income of the joint venture, and the other spouse receives no Social Security benefits. That can ultimately create a big problem down the line when people retire and one spouse goes to claim Social Security benefits and it appears that they haven't been working for many years. So take a look at that. One, you want to first technically report a partnership return, or you can look at Section 761F and put two Schedule Cs in your 1040 and everything will work out quite all right. All right, well, history is repeating itself in a number of areas. One has to do with heavy SUV trucks with a gross vehicle weight of more than 6,000 pounds. Back in the Bush administration, for a period of time, snuck into a bill late at night was the fact that you could go out and buy a Hummer, $75,000 or more, used 100% for business and write off the whole vehicle cost in 1 year. That wasn't known to the legislators when they passed the bill. Eventually it was identified, and the Bush administration said, this was back in 2004, that they'd eliminate or correct that technical error immediately. Well, it took them 2 years to correct that error. So then it made that you could only take up to $25,000 of write-offs on heavy vehicles over 6,000 pounds that didn't qualify as true trucks. Well, oddly enough, in the last tax bill, the 2010 Tax Relief Act, under the Obama administration, once again, there's an opportunity for heavy SUVs to write off the entire vehicle in 1 year if it's used entirely for business. So history repeats itself. On another issue, for corporations, you'll remember that corporations often use blocker companies out of the Cayman Islands or Bermuda, the British Virgin Islands, where offshore subsidiaries of a U.S. company are subsidiaries of the blocker company offshore. That's a perfectly legal strategy so that the U.S. doesn't get to tax profits attributable to customers of those businesses offshore when the factories, resources, people are offshore and the customers are. Well, the deal with that is that you only report income in the U.S. when you bring home the profits from the Cayman Islands holding company into the U.S., to the U.S. parent company, and perhaps ultimately to the U.S. shareholders. That's been a deal that's been worked out with Congress since the early 1970s. In 2004, the Bush administration and Congress passed Section 965, where offshore companies could repatriate to the U.S. all these profits that they had accumulated offshore at a tax rate of 5.5% with certain qualifications and limitations. Well, that was a great deal because they avoided taxation for all those years, brought it back to the U.S., and then the income was taxed at 5.5%, where a normal corporation operating in the U.S. would have had all their income taxed at 35%. The big idea was that it's better to get the cash back here in the U.S. than letting it sit offshore. That was thought to be a one-time deal. Many of my counterparts said that George Bush would get free dinner for the rest of his life from various lobbying organizations by arranging for that arrangement. It did go through. Many of our clients took great advantage of it, and we thought that would be at one time. It could never happen again. But now the Republicans in Congress are actually trying to do it a second time with the view that there's $12 trillion offshore, billions of dollars of potentially taxable profits that could be brought home to U.S. headquarter companies, and they're doing it again. So it's a little bit frustrating because offshore planning takes into account that you have your money onshore and you have your money offshore. And as long as you don't bring the offshore money onshore to the U.S., you avoid U.S. tax, and that's a fair deal. If every 5 or 10 years you get to bring the money offshore onshore for a low U.S. tax rate, like the 5.5% in 2004, well, that just throws the whole party up in the air, and it makes it look like that those who can lobby get the best deals. Okay, then I'd like to take a few minutes here to go through international tax penalties. The tax season's rolling along, and we've just been briefing many of our clients that we have to do these filings on forms that often don't create any tax liability, but the IRS is required to be informed, or $10,000 penalties can apply. Form 5471, if you own more than 10% and certainly more than 50% of a foreign corporation. An extensive filing has to be done. For each non-filing or incomplete filing, the penalty can be $10,000, and if it's willful or fraudulent, penalties can go up to $50,000. Form 5472, instead of a U.S. company owning a foreign company, 5472 is when an offshore taxpayer owns a U.S. company, more than 25%. Again, that form for a non-filing or incomplete filing has a $10,000 penalty. If it's willful or fraudulent, they go up to $50,000, and it's a serious form. Also, but both 5471 and 5472, all the intercompany transactions between the shareholders, related corporations, trusts, partnerships have to be disclosed so that the IRS can trace your transfer pricing and make sure you're leaving the right amount of profit in the right country, most importantly the U.S., for the IRS to tax. Form 926, if a U.S. taxpayer transfers tangible or intangible property offshore, like intellectual property, new software code, a great idea, to invent it here in Silicon Valley and transfer the ownership to a Cayman Island company where the Caymans have a zero tax rate. Well, it sounds like a great idea, but you're required to tell the IRS that the transfer occurred if it's for more than $100,000 in value. That way they can apply Section 367, which in some cases creates a 35% tax on the value of the outbound transfer. For not filing Form 926, the penalties can be up to a maximum of $100,000, plus, of course, you owe the tax on the outbound transfer you didn't report. Form 3520, that's the annual report for foreign trusts, and also if a U.S. Taxpayer receives a gift of more than $100,000 a year, inbound gift from offshore, there's no tax on the gift. Gifts received in the U.S. are never taxable to the recipient, but the gift has to be reported if it's coming from an offshore source on Form 3520. 8865. 8865 is for partnerships offshore. You may not even know or be aware that you're a partner in a partnership where the partnership's operating offshore. Sometimes those can be very sneaky and not apparent because you made an investment. You may have made the investment with a friend, but the friend put the money into an offshore partnership. These forms have to be filed, and the penalties go from $10,000 up to $100,000. There's our old friend, the FIBAR form, Foreign Bank Account Report, Form TDF 90-22.1 that we talked about at length last year. If you have signature authority or financial interest in an offshore bank account, brokerage account, you need to report various information about that. No tax is due with the form, but the penalties are very serious for not reporting the existence of the account and the maximum account value during the year. All right, well, again, I said it was a slow week in the tax world. We're very busy here at GrowCo. taking care of clients. We'll see you again next week. Thank you for watching.